We've seen spectacular growth in the global mobile device unit shipments over the past several years in the range of mid-teens to 20% CAGR. We expect some deceleration in this growth over the coming years, but still expect solid unit shipment growth in the range of low teens to mid-teens. Most of this growth is going to be driven primarily by growth in the emerging markets where cell phone penetration and phone penetration, for that matter, is less than 20% of the overall population. This compares to penetration of mobile phones in developed markets upwards of 70% and even more than 100% in some regions. We believe that Nokia will be a prime beneficiary of the growth in unit sales over the next several years for a number of reasons. First, in emerging markets, Nokia has abnormally high market share, upwards of 60% in some countries, and in particular China and India. This is being driven by Nokia's scale advantages over its competitors. Being the largest cell phone manufacturer in the world, Nokia has developed huge scale advantages and allows it to be the low-cost manufacturer of cell phones. This is important, particularly in emerging markets where an outlay of $40 on a mobile handset for someone earning just $1 a day could represent 10% of their annual income. As wealth is built in emerging markets, handset sales are increasingly coming from replacements or upgrade sales as opposed to new subscriber growth as people are able to afford better handsets. This is important for Nokia as its average selling prices should rise, which should lead to higher operating margins in the future. While growth in emerging markets is likely going to be strong over the next several years, we expect slower yet still positive growth in the more developed markets of North America and Western Europe. The growth in these markets is being supported more by a technology upgrade cycle. As new wireless applications such as music downloads over wireless networks and streaming video are being developed, consumers are demanding handsets that can actually run these applications. This should ultimately lead to higher average selling prices for Nokia's products in developed markets and ultimately higher margins. One of our primary investment criteria at Toron is a company's ability, or the future ability of that company, to make cash returns to its shareholders. We believe that as Nokia grows its unit volume sales, it should be able to extract further scale efficiencies from its business, which should allow it to grow its already high 2% dividend yield, as well as continue to be active on the share buyback front.